Frankly, there are more ETFs today than there are publicly traded stocks. So the amount of investment product or strategies that are out there is just enormous and overwhelming. And there's a lot of things that don't deserve anybody's capital, frankly.
Welcome to Modern Money Moves. I'm your host, Logan DeGrave, the show where we break down financial decisions people face at every stage of life. This show exists to help people understand how coordinated financial planning decisions can change their life. Joining me today is our Director of Investments at Modern Wealth Management, Stephen Tuckwood. Tuck, how's it going?
Hey, Logan, good morning.
Tuck, give the audience a little bit about yourself and kind of what you do here at Modern and how you really help clients and work alongside our advisors.
Yeah, certainly. Yeah. So, Stephen Tuckwood, I go by Tuck. I'm the Director of Investments here at Modern Wealth, and I run a team of investment specialists who are there really to act as an extension of the advisory team and to help with various different investment questions, portfolio construction, and different investment strategy review. And just like many of our other departments across the firm, it is there really to surround the financial plan and the CFP or advisor and offer just different services. So yeah, my role is unique just to investments and again a team of investment specialists that operate in that capacity.
Yeah, Tuck. So, really, what we're here to talk about today is why your portfolio is not a plan. And you being the investment guy, the CFA, I think you do a really good job of working alongside our advisors. And in fact, and I'll let you talk a little bit about it, Tuck, you're not going to go out and tell an advisor how to allocate capital for their client before you actually understand what needs to happen with that client. What are their hopes, goals, dreams, desires? What are the things that they're trying to do in their own life? And Tuck, I think that's a little abnormal somewhat in our industry, even though we believe that's the right way to do things. Um, I think personally, a lot of people do think that their investment plan or philosophy is their financial plan. But I've always said having an investment plan is kind of like having a plan of hope. You hope that you're going to get level of return in the market, and we hope markets won't go down. But Tuck, we're going to talk a lot about that. You know, what is investment management? If you're wondering what we're going to get out of the show today, a strategic approach of building confidence around not only your financial plan, but how you marry your financial plan with the investment plan, where investments fit in, and then how your investments can help you, enjoy, prepare, and connect. And then talk a little bit about our advantage offerings and confidence score here at Modern. But Tuck, in your from your lens, what is investment management? Outside just we're going to own some stocks and we're going to own some bonds. I think more of how we decide to allocate the capital. But where do you see that from your role as you fit in with advisors and clients here?
Yeah, if we boil it right down to the purpose and why, or what we're trying to accomplish with an investment portfolio, it is ultimately to help to power a financial plan to success. That's the real goal behind what we're doing on the investment side here at Modern. So it does just re-emphasize the importance of, yes, initially having a financial plan to understand what our objectives actually are with the investment portfolio. If you don't have that initial objective and what you're looking to try and actually achieve, then you get kind of lost in this realm of, oh, let's just maximize returns or maximize income or some other what can be a very arbitrary goal for any particular individual or their situation. So the financial plan really helps to orientate the investment portfolio to those goals, to that specific situation. So a very simple example that I think does a good job of explaining this is the concept of a timeline. So within the financial plan, there's obviously a timeline around some key milestones. Biggest one typically that we see is a date of retirement. So if you don't
Hmm.
have that timeline in place, then a investment portfolio can look very different from one to another and might not be suitable to help reach that goal. Where you could end up either taking too much risk, over allocating to more of the risky type assets, or the opposite, even under allocating to risk as well. So the various elements of the financial plan, which I think we're going to dig into today, really do help orientate the investment portfolio and provide just instruction and guidelines on how to manage that money in the most optimal way.
Yeah, Tucker. I think one of the ways I've always thought about this when I was an advisor describing it to clients was, how much risk do you, Mr. and Mrs. Client, need to take to accomplish your goals? And I think as human beings, there's the elements with investing of fear and greed. And sometimes if you don't have a clear guidepost to the point you're making, why are we taking all that unnecessary risk? Or are you maybe not taking enough risk to accomplish what you want to do long term? So we think about is a strategic approach. And this starts with building the financial plan and then going in and seeing what are the problems in the financial plan today and what are the potential timelines. And when I say problems, maybe it's something like tax. Maybe we have a tax problem. And I think about this where this comes into your lens a lot is we have brokerage accounts or taxable accounts. So accounts that we have to worry about capital gains, dividends, and interest. Talk a little bit about how you work closely with our tax team on these type of accounts, and why does this matter? Because I would imagine there's a few people out there listening to us that are like, well, why does the investment guy need to talk with the tax guy? How does this all come into form from a strategic approach for the client?
Yeah, there's a real benefit to coordinating across disciplines, as we say. So you've got the investment discipline and then the tax planning discipline. And when they operate independently, you don't get as much benefit as when they coordinate and when they work together. And that really hits home with certain aspects of investment management, where ultimately what matters is the money that's available for the client to spend, and that is an after-tax number. The tax man needs to be paid. They take their chunk, and it's our job really to help minimize that over time. And when you think about investments, one of the great aspects of a well-built portfolio is the power of compounding over time. When you have a situation where you're depleting that portfolio to pay taxes at an inopportune time, that lowers the benefit of compounding, right? There's less money there available because you've just had to pay a tax bill, and it doesn't stay within the portfolio itself and help to really build upon itself. So that's just a great example of real benefit of taking a very much a tax optimized view to the portfolio construction side of things, and making sure just simple things like where more of the growthier parts of the portfolio are allocated to certain accounts. And the tax planning function can really help with that asset location side of portfolio construction, not just what am I invested in, but in which accounts is that happening. So yeah,
Yeah.
very much needs to be a coordinated effort across the different disciplines to really optimize the entire outcome, which is ultimately the most important thing.
Yeah, and Tug, I really think about it. You're talking a lot about long-term alpha and how the taxes impact the portfolio. I even think, and this is kind of putting the tax guy or the investment guy last a little bit sometimes, which is sometimes the role you have to play, depending on the client situation. And, you think about these taxable, these brokerage accounts where we have some capital gains, that's a little bit easier to maneuver. But one of the difficult things is when we have mutual funds within these taxable buckets that kick off these capital gain distributions. And, there's not really a rhyme or reason sometimes of why we get the capital gain distributions that we do. And they can be somewhat unexpected. I can think of a number of cases over the years where we actually work together with you and our tax team to figure out some ETF, exchange traded fund alternatives to get more tax efficient, because these capital gain distributions were either kicking the client into the next IRMA Medicare bracket, or maybe a potential tax bracket, or even potentially we had to worry about income planning because we were pre Medicare and we need to worry about insurance coverage. So all of these things are very connected. Um, and this is why we have what we call plan driven investing here. And one of the things, Tuck, I think you do a great job of is, and I think this is a little bit of a misconception in our industry. Tuck, how many times do you tell an advisor that, hey, look, advisor A, you need to allocate the Joneses capital this way? How many times do you tell advisors that?
Yeah, very, very limited amount. Yeah, that decision really does belong with the advisor and their client. It's one of the most important decisions they can make, and just fully understanding the entire situation takes time and takes conversation and a financial plan to uncover certain aspects of what's important. So, no, that's left at our firm at the advisor level.
I would imagine the conversations go more like, hey, Tuck, or hey, someone on Tuck's team, I have this client. These are the challenges. These are the goals. This is what we want to accomplish. How do you think we should collaborate together to allocate the capital? I would imagine that's really how the dialogue goes.
It is exactly right. Yeah, kind of a collegial group think, and getting the experts together around the same table and walking through some of those challenges that we might be facing with a certain situation. And yeah, really collaborating is the key point.
We talk about something at Modern here. Enjoy, prepare, and connect. And while I think a financial plan is critical for, that preparation piece, that you can say, "Hey, look, I can retire, or I can take this family trip, or I can gift to the kids, or whatever we want to do." Tuck, from my vantage point, I would actually say that investments are one of the main drivers to people who feel like they can either enjoy and connect with what matters, because we're assuming that that costs money. That might be taking a withdrawal from the account. So something that comes to mind for me is, maybe a family trip or something like that. But Tuck, you have a very difficult challenge. How do you work with folks at Modern, where maybe I have a client, we'll say the Joneses, that they want to take their 50th wedding anniversary, and this has been planned, it's all part of the financial plan. But ultimately, let's say that the market's down 20% because of X, Y, and Z. It's a very different psychological conversation to take a withdrawal like that than when the market's up, 20%. So, Doug, how do you help people navigate these conversations so our clients really can enjoy and connect with what matters most in their
Mhm.
lives?
Yeah, it's. I think it's the real benefit of having a financial planner and working with a team of professionals. Is there are going to be situations in life that are difficult. It's not always a great economy out there. The stock market is not always at highs. There are certain challenges that we have to work through, and we seem to have them every 3 to 5 years at this rate. So. Um, it's really about having a well constructed portfolio where we can our clients can still enjoy their money without depleting the portfolio at really suboptimal times. So when the stock market does have one of its corrections, we don't want life to stop for our clients. So we need to make sure we do have a liquidity bucket that is very stable and a very, rock solid part of the portfolio that they can then draw upon at that time and continue to live and enjoy their life. And that's really important ultimately. And there are some clients and personality types where they are reluctant to spend the money that they've earned over time, and frankly end up at the end of their life having not lived its to their fullest and spent time with people that they love at the risk, at the fear of ultimately running out of money. So I think having a really well constructed financial plan that it enables you to really answer the fundamental question, which is, am I okay? And that's the real benefit of it, especially with the more nervous or conservative minded folks that are typically more reluctant to really enjoy the fruits of their labor and the money they've accumulated over their lifetime.
Yeah, one of the things that you see, and you just alluded to, but I saw firsthand in the advisory seat, is it doesn't really matter. And I used to ask people this question: "Hey, look, Mr. or Mrs. Client, the the financial plan's probability of success is at 100%. The market's down 6%. It's still at 100% or 99%. Take the trip. But one of the things is, Tuck, you could say, hey, look, Mr. and Mrs. Client, if your money doubled overnight, would you live any differently? And that was one of my favorite questions to ask people. And oftentimes the answer was no, or maybe they would do something a little bit different. And why I'm talking and saying this is the enjoyment piece of money is more of a psychological thing than necessarily what your statements say. But having the preparation piece and the forward looking thinking to realize that, hey, look, markets just don't always go straight up. We do work with clients. We still work with clients, and I'll say in that accumulation phase of life, but you're really focused on that distribution phase of life when we actually have to get to the assets to live and take withdrawals. That not all your money is going to be correlated to what the stock market does in a day or even the bond market. And I think when clients can see that and they start building trust over long periods of time, they're able to identify, hey, look, my advisor, along with the great team of investment specialists at Modern Wealth Management, they understand that things don't just go straight up, and it's okay to change things. But Tuck, at the same time, from the preparation piece that I see a lot of advisors struggle with in the industry is how often are we actually checking in with our client? So, what happens when goals change? What happens when a life event happens? What happens, when maybe it's not something that's even in the markets, is actually going back to that preparation piece, that financial plan, and working alongside you because potentially we need to change the allocation. And I would imagine that happens quite often when you're working with
Mhm.
advisors.
Yeah, it certainly does. And, life isn't static. And so neither should your financial plan be. It should be a living, breathing document, not something that's created, printed, and then, shoved away in a drawer for a future date. But instead, it should be a living, breathing document that really helps to guide everything within around your financial life. And one of those things could be a surprise inheritance along the way that just changes somebody's financial situation. And the plan needs to be updated in real time to react to that new influx of capital, the changing of assumptions, maybe goals change after that event, and then ultimately the portfolio likely will need to be changed from that standpoint as well. So continuing to optimize all these different things that happen throughout our lives, very dynamic rather than static, and having a portfolio that responds to that, where it's linked to the financial plan itself, not just two separate discussion items or parts of your financial life.
Yeah, where you kind of come in too, even working alongside our advisors, is trying to take the burden of fund selection off of course, the advisor, but also, we have clients that, they've enjoyed it, or maybe they just thought they needed to do it. Tuck, I think that's one of the unique things that we're doing here is you're building a great national menu of investments that our advisors can work, within. You're not saying, hey, look, Mr. or Mrs. Advisor, you got to select these funds. But what you're saying is, hey, look, these are the guardrails in place. It's your job as the advisor to figure out how the capital should be allocated alongside the tax professionals and everyone else. Um, you know, Tuck, how do you think about that with clients and the desire to be in maybe the private markets and things like that when it comes to this preparation piece and making sure that everything is happening the right way?
Yeah. So ultimately, the asset allocation decision, that top level decision of what proportion of my portfolio should be in public equities, the stock market, what proportion should be in fixed income, bonds, what proportion should be in alternatives to those two other asset classes, and then finally, what proportion should be in truly safe, liquid assets that can be drawn upon in difficult times. And that decision of what proportion those broad categories should be will drive 70 to 80% approximately of a portfolio's journey throughout time. So that is the most critical decision in portfolio construction is that broad asset allocation choice. So it's really important that that again does live with our advisors because they know their clients better than the investment specialists will because we're one step removed. Um, but that's where that lives. But then once that's determined, then you do have to get into the nuts and bolts of portfolio construction, which is choosing funds, choosing individual securities, whatever it might be. And that selection is secondary to that asset allocation one. It's not as important. It still needs to be done well, but it's not going to drive the same proportion of returns over time. And frankly, there are more ETFs today than there are publicly traded stocks. So the amount of investment product or strategies that are out there is just enormous and overwhelming. And there's a lot of things that don't deserve anybody's capital, frankly. That's just our industry and how product providers operate. They tend to throw spaghetti at the wall, launch a lot of product, see what resonates and what doesn't. And there's a big failure rate of ETFs and mutual funds that just never get past a critical point to survive in terms of the number of assets. So anyway, that decision of the more granular piece of okay, what fund should we be in, what ETFs, what individual securities, that is where the investment team comes in here at Modern and helps with that decision making, that final piece of the portfolio construction. And yeah, we spend a lot of time reviewing different investment strategies and seeing what's appropriate to be used in client portfolios.
So we talked about the enjoy piece. We talked about the preparation or the prepare piece. The connection piece, we've alluded to this already 6 times since we've been speaking, but it is making sure that we've talked about how the tax plan and the financial plan have to be connected with the investment plan. There's a couple other pieces that we haven't talked about, and that is the risk management plan or, an insurance plan. So, how much personal risk is at play for these clients is something that can go into the investment selection. And then the same thing with estate planning. We don't spend our last dollar on our last day. Where do we want to leave the money? What account should we leave to what beneficiaries? And you alluded to this earlier before I flip it back over to you. Are we maybe taking too little risk with some portion of our assets? So when I think about this, the estate planning piece, it's like, okay, I have a legacy that I want to leave behind to my kids or grandkids. Well, I'm not spending that money today or tomorrow. I probably shouldn't be in T bills with it. But how do you connect on the estate planning and then kind of that risk management piece when you're thinking about the investments?
Yeah, it's really about optimizing for the end outcome. And to do that, you need to know what are the likely outcomes here. And that estate planning piece that you described is a good one, in that you might reach a certain point in your life where you are thinking about the next generation and you want to leave a lasting legacy on to those behind you. And that means a different portfolio style than what we might have been doing initially, where a client enters retirement, then they're in distribution mode and need to live off their portfolio and the income. This now has a completely different timeline for that portion of the portfolio to optimize for that next generation. That, like you say, they might be a younger demographic and have a lot longer of a runway. So that's important just to work around that. And then also on the risk management side, that might be your primary goal, to leave a lasting legacy. But if something occurs that is a gap in the plan, let's say you need long-term care, which is a considerable cost, and only getting higher, then if you're not insured against that risk, then that really does open you up to failure of your plan. Not that you might run out of money yourself, but you can no longer leave a lasting legacy because you've spent all that extra money that you thought you had covering the bills associated with long-term care. So bringing in a risk management specialist, having that discussion of, hey, where are the gaps now in this plan? How can we make it rock solid so that there's a much higher likelihood of achieving the goals that are important to me? That's where that collaboration comes in.
Well, let's talk a little bit about our advantage offerings. And you're describing what we do here at Modern, and you just talked about two pieces of it. We've talked about, I believe, the rest of the pieces throughout the show. It's a lot to manage. I often say that, people come to us and they have this stuff, the social security, the investment accounts, maybe a pension, maybe this, old estate plan and this insurance. And it's our job as a team, a connected team led by the financial advisor, your financial advisor you're working with at Modern, to coordinate on all of this on your behalf. Because you just made a excellent point, Tuck. If you overlook the risk management, piece of the financial plan, you can have a great tax plan. You can have a great investment plan, and you may be able to spend money, however you want, or and take these family trips and gift, but then life happens. And you didn't stress test the long-term care. And no, we're not saying you got to go out and buy a long-term care policy. That's not what we're saying. But what we are saying is, what is the plan in case something happens? And then what are the potential trade-offs? So what I mean by that is what you said. Hey, look, God forbid we have a cognitive impairment, we have a longer long-term care stay, and we spend through the portfolio or a portion of the portfolio. What did that impact that surviving spouse potentially? But how does that impact the legacy? And then the same thing, we've talked about some negative things. Let's talk about some fun things. So we've had a great outcome with the tax plan and the financial plan. And so that person that retired, maybe they can do things that they never thought they could be able to do. And it's the advisor's job to continue to play, quarterback, point guard, whatever analogy you want to use, to ask the questions, understand what matters to these people. Because, Tuck, the worst thing we can do as financial advisors and, professionals in this industry is rob a client of the most precious commodity we all have, which is time. Tuck, what's your take on how we have this integrated solution that we call our advantage offerings?
Yeah, it's really, the holistic answer. It's the holistic financial planning and all the elements that are involved there. And, just managing any one of these complex areas independently, it is just suboptimal. It is better when things are collaborative, when all the disciplines are working in harmony around a financial plan, which is at its essence the things that are important to a client. That's really how to orientate all the different areas of holistic financial planning and really to optimize to get a great outcome.
Yeah. And I'll just use one more quick example. With estate planning, you had this great plan, this rock solid plan. You had wonderful outcomes in the markets with your investments, but you didn't put any beneficiaries on your account. Now everything's going to probate. Right. It didn't really matter how great of an investment outcome we had, because that's not the potential legacy we could have left behind. So how we think about this in Modern is through the lens of our advantage offerings. But how do we actually make sure that we do this? And we do that through what we call our Modern Confidence Score. And, really for us, it is how confident are our clients, but also people that are our prospective clients or want to come sit down with us, of how good of a job are we doing in all these different areas of our life? And it could be a number of things. One, you could think that everything is rosy and perfect and you're very confident in these areas. Okay, let a professional and a team of professionals validate that for you and make sure that things are what they seem. The same token as you may know that you have a tax problem or estate planning problem. Okay, let's start with that problem to start building confidence in that area. And our goal is, when you look at these two things side by side, I often say people will come to us kind of in this, that lower confidence. We got some yellow and we got some red there to have things fixed, to get this coordinated plan because they're not confident. Now, hopefully, by working with a team like Modern Wealth Management, you're going to gain confidence and you're going to gain clarity over time. And sometimes it's not just the dollars and cents, but it's also that empowerment to be able to enjoy, prepare, and connect with what matters in yourself. So, talk when you think about the Modern Confidence Score, from your lens, it would be very, if we just looked at investments centrally, it would be very ebb and flowing with what the markets and what investment returns were doing and what was happening in the economy. I think we can all agree there. But having all this coordinated together, I don't think we have the volatility in the scoring just because there's a bad day in the market like we could. And, if you're just living and dying by an investment plan, which is kind of the heart of the show here.
Yeah, it's markets are up, I feel good. Markets are down, I feel bad. That's no way to live life, right? So, um, having a having a very intuitive way to uncover how you truly feel, how confident you are in these different important elements of your financial plan. That's ultimately what we're trying to uncover here with the confidence score system. And I think it does a great job of doing that, and has led to some, just really great conversations and uncovering things that, they might have been missed prior. So, all about just continued discovery, continue understanding of what's important to our clients, and then helping to solve for that.
Ultimately, the work never stops. And, you could look at a confidence score and, one day or one year you could be having a lot of 4 and 5s and, be in that green shade. And life happens, things happen, and, we have to be able to adapt. And, you know, ultimately why investments matter and why a coordinated plan matters is at the end of the day, and I'll say this not to undermine our investment guy on the phone, but on the video, is they are the engine that drives things, right? You could have a great financial plan and you could have a great tax plan, but if you're not generating returns that are needed to achieve the financial planning results, you're going to have a problem, right? If you're not generating returns that are going to long-term returns that are going to lead to keeping up with inflation and college inflation and healthcare inflation and these goals that you've set aside, there are potential problems there. So, Tuck, I think, well, if you spend a lot of time talking about other parts and the coordination, you still got to get the investments right.
It is the fuel to the financial plan, so it shouldn't be the thing, because again, without a correct orientation, then what is it you're trying to achieve? You do need to have something to orientate towards. You need a target, and that's again what a financial plan really helps to provide. But then, to your point, you need to do it well. It's no good getting half the returns that the financial plan might need, or with different type of income that's on a after tax basis gets really watered down, and the money in your pocket is not what you thought it would be. So, definitely need to do it well, and there are many ways to do it not well and bad on the investment side. So many ways to do it right as well, and we're obviously working very hard to get that end result. But yeah, it's a moving target, but it needs to be done well, and that's why having a team of investment specialists at the advisors side can really help out.
Yeah. Well, look, if you're listening to anything talking we've talked about, and maybe you're not confident in a certain area of your life, or you're not confident in the coordination of these efforts, reach out to us. Reach out to our concierge team. We will get a confidence score in your hand and a meeting with an advisor where we can actually either validate or deliver some confidence in these areas that you're seeking. So, Tuck, thanks for joining us on Modern Money Moves. We'll see you next time.